Okay, Chris. So we're talking about something called a HECM.
Yes,
Tell me about that.
what the heck's a HECM?
What the heck's a HECM?
Well, thanks, Russ, for having me on. So the program we're here to talk about today is officially called the HECM for Purchase. We affectionately call it the Lifestyle Home Loan.
Okay.
And this program has been around since 2009, and it's designed specifically for people 62 and over.
Okay. So 62 all the way up to whatever.
All the way up to whatever.
Okay.
Yes,
Cool.
all the way up to whatever. And this program is simply an option that allows people to be able to purchase their home without having to use 100% of their cash and without having the burden of making monthly mortgage payments.
Okay, hang on. No mortgage payments
Correct.
and not using all your cash.
That's right.
Okay, so how does that work?
Sure. So the program is an FHA insured mortgage that's designed, again, for people 62 and over.
Right.
And it requires a one-time down payment of somewhere between 50 to 65% of the price of the home.
Okay.
So you're going to put down a sizable down payment of anywhere from 50 to 65%.
Okay, so we're talking $400,000 home. You're maybe doing about 225.
Correct. Roughly?
Cash.
Correct.
And no mortgage payments.
No monthly mortgage payments are required.
Holy
So
cow.
you can make payments if you want, but
Okay.
you're not obligated to.
Okay.
They're
great.
optional.
Okay, so how does that help us in our goals to purchase a home today?
Sure. Well, in retirement, from a financial planning standpoint, and just from a pure 30,000 foot viewpoint, having liquid cash in the bank and having cash flow are two of the most important things in retirement.
Okay.
If a person pays 100% cash for the retirement home, they're going to have a significant portion of their overall nest egg locked up inside the walls of that house.
Right.
That money is now illiquid, cannot
Okay.
be used.
Right.
So paying cash for a house is great because you don't have a monthly mortgage payment, but paying cash isn't so great if A, you don't have enough cash to buy the home that you really, really want to buy,
Right.
or if you do have it, it might represent a significant portion of your overall nest egg.
Right.
So having that much cash tied up in retirement may or may not be the best financial planning option.
Okay. Okay. So let me spin back here because this is a lot. So I buy this home. I only pay around 60% down. I never make a payment, and I keep the rest of that money.
Correct.
What obligation does the rest of that money have? Do I have to keep it just in case?
It's there for whatever purpose you want.
To go on a cruise.
If you want to go on vacations, if you want to spoil your grandkids,
So I want to go on a cruise.
sure. We've actually had customers buy a condo for their daughter so that their daughter could live close by because mom and dad didn't have to use all their cash to buy their home. So they had enough leftover cash to buy their daughter a condo so that the grandkids
Nice.
could be close by.
Or they could have went on a cruise.
Or they could. Correct.
Okay.
That's right.
Okay, so this is a really great sounding product. So who qualifies for this and why would they want to qualify?
Sure. So the program, again, is designed specifically for people 62 and over. So if it's a married couple, at least one person has to be 62.
Okay.
But we always use the age of the youngest person to calculate the down payment. The down payment is a formula based on the same principles as life insurance. It's based on age and life expectancy.
Because Mutual of Omaha is a life insurance company also.
Who knows life expectancy is better than life insurance companies?
Right. Okay. All
Correct.
right. I got it.
Sure. So basically the premise is when you're younger, you theoretically have more years to live. So you have to put more money down.
Right.
But as you move across the age spectrum, if you're older than 62, your down payment is going to be less. So it's an age-based lending program.
Okay. Got it. So that brings up a question. I'm buying this house. I'm giving you 60% down. Who's paying the rest of it?
Sure. So it's a mortgage. So
Right.
we have a lien on the property, okay, just like any other mortgage.
Right.
The home buyer is still responsible for making the property tax payments, keeping the home properly insured, paying HOA fees, and maintaining the property. The same obligations you would have for any other mortgage.
Right.
Okay.
Okay.
So getting back to the qualifications is that if a person is not married and they're buying that home with another person, they both would have to be 62 to qualify.
Good point. Good
Yes,
point.
they both have to be 62.
So number one thing is one of you has to be 62 plus, and you have to have approximately 60% down.
Correct.
Okay. So I shell out the 60% down, and now I never make another mortgage payment. Okay. So me and my lovely wife move in.
Correct.
All of a sudden I get sick and I'm not here anymore. What happens? What's going to happen to my wife?
Well, it's actually very comforting to know that the surviving spouse can also stay in the home for the rest of their lives and also not make any payments back. So the loan the loan becomes due when the property gets sold or when both borrowers have passed away.
Okay. Okay, one more quick question then.
Sure.
Since I'm not making a mortgage payment, interest is accruing.
That's right.
Okay, what happens in the rare case that I might get upside down in that mortgage and now I have a $500,000 home that's worth $450,000?
Sure.
Who pays the difference?
Great question. So this program is insured by FHA.
Okay.
It's completely regulated by HUD. It's insured by FHA. There are insurance premiums that are collected as part of the closing cost. And if that event would ever happen, the one you're referring to, the heirs in the estate and the homeowner can never be liable for anything greater than the value of the property itself.
So my kids won't have to pay.
There is no personal liability whatsoever to the heirs or to the estate. So it's
sounds
actually called
pretty
it's called a non-recourse loan. That's the
Okay.
legal term. So if you look up the definition of a non-recourse loan, non-recourse means there's no obligation to the family to pay any deficiency.
Okay.
So FHA would pick up the difference if the home cannot cover what's owed on the loan.
Okay. Well, that makes sense.
Sure.
Okay, Chris, what's your phone number so people can reach out to you?
Sure, I'm based in Tampa. My number is 813-857-4565.
Okay, perfect. So you can reach out directly to Chris if you choose. Just tell him you're working with the Walker Vantage team, and whether that's me or Justin or Emily or whoever. And you can ask any questions. You can ask for a copy of this guide if you want, or you can reach out to us directly and we will send you a copy too. This is a great product, you guys. And thank you so much for joining us today. And I hope to see you real soon.